Cast is now starting. All attendees are in listen-only mode.
Welcome, everyone, and thank you for attending today's Estate Planning and Charitable Giving webinar presented by Martin Shankman and Jonathan Blotmacher. It is our ongoing privilege to be associated with two of the estate planning community's top attorneys. We are recording the webinar and will send slides and the recording to everyone who is interested. Good afternoon. My name is Brandon Centula with Peak Trust Company. Peak successfully operated as Alaska Trust Company for nearly 20 years prior to our expansion to the Nevada marketplace 2 years ago. We have been and continue to be a pioneer in the progressive trust legislation that exists today. Peak offers a full range of custom fiduciary solutions for you and your clients, along with a choice of top-tier trust jurisdictions. It would be an honor to provide our services. If you have any questions, please contact me. My name and number are shown on the PowerPoint presentation. Thanks again. We hope you enjoyed this informative session. And with that, I'll pass this over to Vanessa at Interactive Legal Services. Thank you.
Well, thank you very much, Brandon. I'm Vanessa Kanega. I'm the President and Director of Content Development with Interactive Legal, and we're very pleased to sponsor this webinar. I think you'll enjoy it. I got a sneak peek of some of the slides, and it features the kind of innovative thinking that we really champion at Interactive Legal. So, and we certainly feature several options for charitable planning within our programs, our Interactive Legal programs. If you're interested in that or any of our upcoming educational programs or materials, I would encourage you to visit our website at interactivelegal.com. And my email is on the slide presentation. You're welcome to contact me as well. And without further ado, I will turn it over to the presenters. Marty, I think I will hand it off to you.
Thank you, Vanessa. We're going to advance the slides. We're going to start with a discussion of some proposed regulations that just came out, I think, like last week, to address some of the planning the high tax states like New York, New Jersey, and others had contemplated to transform non-deductible state income tax because of the SALT limitations enacted in the 2017 Act into charitable contributions, and how the service intends to put the kibosh on that. Joining me for the program today is Jonathan Blotmacher, and I encourage Jonathan to interrupt and comment as often and frequently as possible, and we'll just kind of banter back and forth as we go through the program. Just to be clear on the program, given the incredible impact that the 2017 Tax Act has had on charitable giving, which is monumental, we're not going to do a basic or general or broad charitable giving planning program. Rather, we're going to really focus on what the new act has done to charitable planning. Many, if not most, of our clients will no longer get any charitable contribution deduction. Most estates won't get a charitable contribution deduction, and the impact of that on our planning and our drafting is very significant, and that's what we're going to focus on. In particular, one of the things, and I'm asking Jonathan formally to jump in and help when we get there, is there's some very creative uses of non-grantor trust to really provide most of our clients the ability to get a charitable contribution deduction that won't otherwise get it. And it's important to note at the outset, this is not just for ultra high net worth clients. Even the more moderate wealth clients will benefit tremendously, maybe even more so, from the kind of planning that I just mentioned using non-grantor trust. And there's some interesting nuances because the 642C deduction is very different than the 170 deduction, and we're going to talk about those nuances when we get there. So let's get started. And as I mentioned a minute ago, the 2017 Tax Act, as everybody knows, had severe limitations on deducting state and local taxes. They've capped them at $10,000, and that will really create considerable financial hardship for a large number of our clients. The percentage of taxpayers affected is quite limited, and perhaps that was something that was being counted on. But the high tax, or as many people have called in this discussion, the blue states have enacted, several of them, legislation that would enable their resident taxpayers to make donations to certain charities and then get a tax credit for having made the donation. And this is just one of the many tactics that have been tried to help their citizens because of the restriction on state and local taxes. It's interesting to note on slide 8 that the Joint Committee had estimated $668 billion to come from the state and local tax restrictions. In other words, the SALT limitations are really paying for a large portion of the tax cuts of the 2017 Tax Act. And as a result, the IRS has to backstop those, or there's little chance that the revenue estimates could possibly work. I mean, we may be skeptical about whether they'll work or not in any event, but if we're allowed to circumvent and plan around the SALT limitation, as Jonathan and I and other commentators have tried and have looked at, it'll eviscerate the income projections. They estimate that 90% of taxpayers won't claim itemized deductions of any kind. It's estimated 5% will itemize but not have a SALT deduction above the cap. So this is really down to only about 5% of taxpayers. But my guess is for those of us practicing in high tax states, that's probably the vast majority of our clients. So here's what the states have tried to do. And here's how the proposed regs work. So instead of me making a payment to my state for income tax purposes, I can give a donation to a charity and get a tax credit. What the regulations do is say the following. Let's just go through the example on the bottom of slide 10. An individual makes a payment of $1,000 to a tax-exempt entity under Code Section 170C, and in exchange for the payment, they get or expect to get, meaning they may not actually get it, a state tax credit of, say, 70% of that $1,000. What now has to be done is the contribution deduction has to be reduced by the expected, which could be more than what's actually realized, contribution tax credit for having made the contribution. So the result is that it effectively emasculates the intended benefit from these programs. It's not clear how the states will react. Jonathan, do you want to comment at all on the planning and some of the efforts of the states before we go on?
Yes, thank you, Marty. There are 2 or 3 things to keep in mind. Number one, New Jersey, New York, and other states have already sued the federal government claiming that this limitation of $10,000 a year for SALT deductions is unconstitutional. Now, you might say, how can that possibly be? Well, if you read the papers, they make a fairly credible case. Keep in mind, however, that this limitation is supposed to go away after 2025. And in fact, if we have a regime change in Washington, D.C., it could all happen earlier than that. And I don't know how quickly this will get through the courts. And I also don't know how many individuals are going to try to do it when the federal government has a rule which says that you're just not going to be able to do it. So you wind up having it disallowed by the IRS. Maybe someday the courts will rule that's wrong and you should get it. But I think that this proposed regulation is going to throw a real damper on it. Now, there are a couple of questions, however, including whether or not that regulation is valid. As many of you know, one of the most important decisions in modern time given by the Supreme Court was a case called Chevron versus the EPA. And there the Supreme Court ruled that the federal courts had to uphold any regulation that's issued by the agency, such as the IRS, which is responsible for enforcing the law. And in fact, that regulation has to be upheld basically unless it's found to be arbitrary and capricious. However, a couple of years ago, the Supreme Court kind of reduced the deference that the federal courts had to give to regulations where it is a matter of extreme national importance. And that arose in the Obamacare situation. You may remember that there were states that sued that said they didn't have to pay attention to Obamacare. And the Supreme Court basically ruled that yes, you do, and we are not going to strike it down because it's of national importance. Well, this limitation on the SALT deduction, which as Marty pointed out, is going to cost the American taxpayers about $670 billion over the next 10 years, is one of national importance, so that the deference ordinarily given to an IRS regulation isn't there. And presumably the courts will weigh whether or not the regulation itself is valid, because there's nothing at all in the legislative history to the 2017 Act which says that a state can't give a credit for a contribution to charity, or why that charitable deduction would be disallowed for the individual who made it under Section 170. So the good news is that there will be challenges. The bad news is it may be a very long time before we get a definite answer, and it may chill taxpayers trying to take advantage of what the states are trying to do, which is to give a charitable deduction in lieu of paying a state income tax or a local real estate tax, and then getting a charitable deduction on the federal. By the way, there's an article about this that Richard Fox, who's a well-known charitable tax lawyer, and me, in today's issue of wealthmanagement.com. That will also probably be republished in Forbes and a number of other places. So if you have nothing else to do in your life, look for it, read it, and try not to fall asleep.
So let's go on, and that was the latest new development, which is pretty significant. But let's now focus for the rest of our time today on what we'll call more traditional charitable planning. Slide, it looks like 12 or 13. How did the 2017 Act affect charitable giving? We all know the changes, but let me just go through them really quickly, and may be helpful to some of you. You may not have seen some of the numbers of what this is going to do, and I think it's important to show why we really need to plan differently for clients. So the estate tax exemption has doubled, as we all know. It's 11.18 million this year. Very few estates will get a charitable contribution deduction. The numbers I saw, and if you heard of a different number, Jonathan, say it. I heard that there'd be less than 3,000 estates a year that will pay any estate tax. So that's a pretty insignificant number of people that die that will get any estate tax charitable contribution deduction. The standard deduction was about doubled. I think it was 12,700 to now 24,000 for married filing joint. One of the estimates that I saw, and there are some prior estimates in our previous discussion, but one of the other estimates I saw is the number of itemizers will drop from 30 million to 5 million. So very few clients are going to get a deduction for charitable contributions. How can we help them? So what else did this do? Let's talk about some of the other implications. In 2026, as Jonathan mentioned, it all reverts back. The estate tax exemption is cut back in half. So we need to be mindful that any planning we're doing may have a short time window. The Medicare surtax, the NIT tax, was not repealed as we had thought. Charitable gifts from a trust gross income do reduce the income subject to the NIT, but not for individuals. We're going to talk about that later. The doubling of the standard deduction, the estimates that I saw were that could reduce charitable giving by $13 billion a year. The doubling of the estate tax exemption, and I'm not sure how this is calculated in terms of what it does with the sunset, but it's estimated to reduce bequests by $4 billion a year. So this is indicating that nearly $17 billion a year that would have gone to charity may not because of these tax changes. So there's really an imperative for all of us as advisors to try to use some creative planning to help offset these losses and salvage some of the tax benefits for clients. And certainly, it's true that non-tax benefits are critical. I mean, if you gave $1 to charity and got a 50% deduction, you're still out of pocket 50 cents for the dollar. So non-tax benefits have always weighed heavily, but I don't think the impact of the tax benefits that are being lost will be insignificant. I think it'll be very significant. So what can we do to update estate plans to address some of this? So one of the things we could do is in trust, irrevocable trust, and testamentary trust, consider providing powers of appointments so that somebody can add charitable beneficiaries. we can consider adding to powers of attorney the ability to make charitable contribution deduction. One of the things that's important in planning is if a client that when they would have made a bequest, would have anticipated getting a deduction, now will not get any type of estate tax deduction. What about adding to, say, a power of attorney or revocable trust, not only the right to make charitable contributions, but the express right for the agent or successor trustee to repay as an advancement the charitable bequest made under that client's will. That may facilitate getting an income tax deduction because a large deduction that would have been made under the will is instead made during lifetime. It should be well over the standard deduction. It will provide some income tax benefit, which is certainly incremental or better than no estate tax benefit. Now, before we go on to the next slide, one quick point too. When you draft a power of attorney or revocable trust, how do you delineate the types of donations the client wants to permit? Obviously, a client could list specific charities and authorize an agent or successor trustee to donate to them. One of the approaches too may be to say, in accordance with my historic pattern of giving, so any of the charities that the client gives to and the dollar amounts that were given could be continued. So another issue, life insurance. One of the things that's happening is a number of clients are considering whether or not they need insurance. Clients, for example, that bought survivorship coverage to pay an estate tax may no longer need it. Certainly one of the steps that could be taken is to donate policies that clients no longer want to charity. If it's a well-funded permanent policy, there may be some pretty considerable interest by a charity, especially if that can be coupled with a planned gift that will fund the policy into future years. Let's talk about some of the changes to charitable giving. So one of the changes was that we had a cap on 50% of adjusted gross income for charitable donations, and the new law increased that to 60%, but only for cash contributions. There was a lot of press given to the second item on slide 20, which was donations to colleges that would give you a right to buy tickets to athletic events. Those are no longer deductible. There is some strengthening of the requirement to maintain contemporaneous records. One of the exceptions had been eliminated. Not directly in the charitable area, but certainly something quite important for large donors is the P's limitations have been eliminated. And as a result, some wealthy taxpayers will now be able to avoid that limitation and get a larger charitable contribution deduction. Jonathan, did you want to comment at all on Section 68?
Yeah, Section 68 has now been suspended through 2026. So you won't have to worry about losing your charitable deduction on account of Section 68, which basically said that once your income got over a certain threshold, you would begin to lose itemized deductions. And that probably was not a problem if you lived in a high income tax state and you were itemizing, such as Marty being in New Jersey or myself in New York did. But if you lived in a state like Florida or Texas, which had no income tax, then you basically, that reduction in your itemized deductions pursuant to Section 68 would apply basically to your charitable donations. Now it will no longer be. So if you're representing wealthy people who want to give money to charity and are concerned that they wouldn't get a benefit, as was the case when Section 68 was in effect, no longer have to worry about that.
Now, one of the things that's received a lot of press, and I think we kind of need to mention it just because it's been talked about so much, but I don't think really has the impact that many have talked about, is bunching deductions. So we'll go through it kind of quickly just in case you haven't heard about it or read about it. Your clients very well may have. Can we go to the next slide? So bunching is the following. I can defer paying itemized deductions in 2019. In 2020, that'll be my target year. I'll pay the deductions I deferred from 2019. I'll pay the 2020 deductions, and I'll accelerate back into 2019 from 2020. the deductions I would have deferred and paid in that actual year, so that I've in effect put 3 years worth of deductions into 1 year, and therefore I'll get over supposedly the $24,000 standard deduction hurdle. The idea is that that will be a way that clients can aggregate or bunch deductions into a target year, exceed the exemption amount, and in the 2 other years that they've pulled deductions out of, use the standard deduction. The problem with that approach is I don't think it's very appealing to a lot of taxpayers. People that are used to giving money to charities each year may not be comfortable bunching them into 1 year. The solution, and this probably is part of what gave rise to the idea getting so much publicity, was that you can make your charitable gift to a donor-advised fund in that target year and then dole it out over other years, and thereby both bunch deductions but pay out your charitable contributions over a longer period of time. The problem is, unless you're kind of at the cusp of the standard deduction amount, I'm not sure this is going to really push you over, and I think it's just contrary to what a lot of people want to do. And with the SALT cap of 10 grand and so many itemized deductions having been eliminated, there's just not a lot of discretionary itemized deductions. It almost seems like the only real discretion you have is elective medical procedures, so I'll decide which year I get my nose done, or charitable contributions. There's just not a lot to really work with in that context. So there's an example on slide 23 of how that works. Your clients will have heard about it. I just don't think it's going to do much for too many people, but we have better solutions coming. Slide 24. One of the great things, but I think just as a preface, this helps emphasize how granular or client-specific planning has to be. Using a qualified IRA distribution to charity is probably one of the best tools for some clients, but only works for a very limited group of clients. So if your client fits the profile, this is a phenomenal tool. We're going to give you tools that can apply to a much broader range of clients. But I think that's one of the difficulties we all face planning for clients post-2017 Tax Act, in that we need a much bigger bag of tricks and tools and techniques, and have to be much more selective and careful what we pull out for each client, because we just can't use standard planning for a large swath of clients like we might have in the past. So the qualified IRA distribution, you have to be 70 and a half, and it's not the year in which you're 70 and a half. You have to have passed your 70 and 1/2 year birthday in order to do this. And you can have a qualified distribution of up to $100,000 from IRA made directly to charity. And the beauty of this technique is it comes right off the top. It's not included in gross income, and so therefore it has no impact on the standard deduction. So it's not reduced. So it's really a dollar for dollar equivalent of a charitable contribution deduction. So the qualified charitable distributions from an IRA are really more powerful and beneficial than they've ever been, given the new restrictions, and that few taxpayers will get an itemized deduction if they pulled the money out from an IRA and did not do this. Some of the cautions to be mindful of, in addition to the being past 70 and a half, is the money really should go directly from the IRA's custodian to the charity. One of the things that worries me, and I had a client that received a checkbook to use for qualified charitable distributions from her IRA, and it just makes me worry when a client takes control over something like that, what will happen. So just be mindful to find out how the clients are planning on implementing this if they're going to do it. Another thought, there have been lots of discussions about the incredible benefits of converting your IRA to a Roth. Keep this qualified IRA distribution to charity in mind as a possible exception. For clients that are charitably inclined, it might be beneficial for them to leave some money off the conversion table to be used for charitable gifts after 70 and a half.
Marty, let me
yeah.
let me add a couple of points here. The United States, I understand, is one of the few countries which allows you an income tax deduction for charitable contributions. That's a big deal. But usually, when you're giving away, you're in a bracket, you're not going to get much of a benefit from it. But the beauty of making the contribution from your qualified plan is that you're basically getting a deduction at ordinary income tax rates, because that money which is now going to charity otherwise would be taxed to you as ordinary income. And as a consequence, it really can be very, very beneficial. So if you want to make a significant donation, you're not going to have to worry about itemizing or not because it's not going to be deductible by you. It's basically you're not going to have to include the amount given to charity in your gross income. So it can be extremely effective. Marty, you talked about bunching deductions. Suppose someone, says, geez, I'm going to be over the next 8 years until 2026 when it all changes. I'm going to be giving a lot of money to charity, but, each year it may not be enough to really make it worth my while to try to itemize. And you talked about bunching. But, people want to give money to the Red Cross, the American Cancer Society, their college, their church or synagogue every year, and they don't want to just do it at one time. What can they do to spread those out but get the tax benefits of bunching?
Well, you can donate to a donor advised fund, and then you can write checks out, have checks sent from the donor advised fund each year. So if you wanted to bunch the next 8 years worth of charitable contributions into 1 year and take a deduction over the hurdle and then use the standard deduction in future years, you could have the donor advised fund dole the money out over the next 8 years. So that's certainly doable.
Well, in fact, my wife and I on December 29th created a donor advised fund equal to what we figured we'd be giving to charity over the next 8 years. So we got the deduction in 2017, when, by the way, it was worth a little bit more because the top federal rate was 39.6 as opposed to today 37. But still, you're going to be better off, I think, doing something like that because you can, again, get a bunch of those deductions all now, get all the deductions at this time, and then you can just dribble it out as you want to. And most donor advised funds, Pete, for example, has one. They'll allow you to make very small donations, and you can even make them anonymously. So if you want to donate to a charity one time, but are worried, which always happens, that you'll get constant calls from that charity to please give more. Even if you said, please don't call me, they know you care about them and they'll continue to call. I mean, my wife and I'll bet, and I'm not exaggerating, get at least 10 calls a day from charities that we've donated to. Well, now with the donor advised funds, we've made a couple one-time gifts to charity that are anonymous. It's just we've had $100 or $1,000 or whatever it is go to the charity, but the charity doesn't know it's coming to us or who's responsible for it, so we won't get those calls. So really consider a donor advised fund as one of the ways to do it, and that's something that you can consider. But Marty is also going to lead us into something about, as another alternative, using a non-grantor trust to make donations. But Marty, now you're going to tell us about donating appreciated property.
Yeah. So donating appreciated property has always been part of the charitable planning landscape. And it's been very common that our clients would have their financial advisors, wealth advisors, contact them in November, December, and they would cherry pick the most appreciated securities, donate them to charity. If they had a position they paid $100 for and it's now worth $100,000, they'd get the full $100,000 tax deduction and avoid including almost $100,000 in taxable income on realizing the sale. So it was really a great opportunity. Under the new law, if the client gets a full deduction because they're giving so much to charity and have other deductions, that still works. But for the vast majority of people, and keep in mind the stats that we quoted you earlier, 30 million itemized before, now it's only 5 million, few people will get a charitable contribution deduction for what they donate. So donating appreciated property still can be beneficial because you're still not recognizing the gain, the appreciation, even if you're not getting a deduction. But that benefit for most of our clients will be dramatically less. And I think because this has been so second nature to many financial advisors and charities, we need to make sure clients understand it. What's more important, and we're going to come to in just a quick minute, is that the rules for charities are quite different, and you've got to be very careful. And we'll emphasize that again in a minute. Another idea, and I think this is Professor Chris Hoyt's idea, to give him credit for it, is on slide 30, you could make an estate bequest be paid from income. So in other words, instead of making a bequest of $100,000 from corpus under your will or under a client's will, you could say all the income from my estate up to $100,000 will go to XYZ charity, and allocate all the income to charity so that you will have an offset, because estates, like trusts, but in contrast, individuals do not have a standard deduction. So that may be an interesting and different way to do it. There's an example on slide 31 illustrating how this technique may work.
Right.
So for a number of clients, this could be a very interesting approach. Jonathan?
Marty, before you go into example, which will be helpful, let me point out that you're not going to get an estate tax charitable deduction. Again, the vast, vast majority of people aren't going to have any estate tax anyway. So this is how we're going to try to get an income tax deduction for basically a bequest to charity. One thing you can do is to have your bequest to charity consist of your right to income in respect of a decedent. For example, if you want $1 million to go to your favorite charity when you die, or $50,000, you can have it paid out of your IRA. So rather than designating your spouse or your children as the sole beneficiary, you can have basically the first $50,000 or $1 million from the IRA, because again, that IRA is going to represent ordinary income. And if you have it go to charity, there's not going to be any income tax paid on that at all. But if you don't have that and you still want to get the benefit of an income tax deduction for something you basically have paid to charity at the time you die, but you don't have the right to income in respect of a decedent, like the right to a payment from an IRA or a qualified plan, then what Marty is suggesting is you have the tax income of the estate be used to pay charity. And if you set it up the right way under Section 642C, basically you'll get an income tax deduction for what otherwise would be a non-deductible bequest to charity, non-deductible in an income tax sense.
So one of the ways you can do it is through the estate. Another way is illustrated in the bottom of 31. Client dies, leaves her estate and trust to her children, and designates that that trust will donate the first $150,000 of gross income after her death to charity. It'll be a dollar for dollar offset. So again, planning becomes more specific to each client, more granular, more tailored, but with a little bit of creativity and thought, we can often find ways to salvage charitable contribution deductions. Let's go on. Life insurance, we've talked about potentially donating life insurance for clients that feel they don't need it anymore, and that's something that's certainly worth looking at. We've talked about advancements on slide 35 and 36. So now let's get into what I think is really the heart of what we as practitioners can do to help many of those clients, and not necessarily the very, very wealthy clients, but just the moderate wealth clients, salvage all of their charitable contribution deduction. And this is a different use of planning that we've done in the past. And I think it is something that can be done cost effectively for even lower wealth clients and help salvage every dollar charitable contribution deduction for them. So what is it that we should look at doing? So one of the things that we can do is use non-grantor trust for charitable giving. Jonathan, do you want to lead this off with some background on this?
Sure. As we know, if a trust is a grantor trust, it's ignored for income tax purposes, and the income deductions and credits of the trust are attributed to the grantor as though the trust did not exist. But if it's not a grantor trust, which we typically call a non-grantor trust, then it's a separate taxpayer. And the basic rule under the Internal Revenue Code is that a non-grantor trust and a decedent's estate is taxed the same way an individual is. It's not really taxed as a partnership or a corporation. It's taxed as an individual is, except to the extent that the Internal Revenue Code has a special rule. Probably the two most important special rules, where it's different from that of an individual, is the deduction to the estate or trust for its distribution to a beneficiary of its distributable net income, DNI. And as all of you know, DNI is only slightly more complicated than DNA. So that's the first major one we have. The second exception is the charitable deduction. Individuals can make donations up to the thresholds of 50% or now 60% for cash gifts to public charity. It can be as low as 20%. And it can be of any kind of property other than ordinary income property. You can't give away ordinary income or even short-term capital gain property, and certain other property won't give you any deduction at all. That's why the donation of an interest from an IRA or a qualified plan works. But for a non-grantor trust or a decedent's estate, the rule is different. A non-grantor trust or a decedent's estate is allowed an unlimited deduction. There's no 20%, 50%, 60% of adjusted gross income threshold, but an unlimited deduction for its gross income. Notice we're talking about gross income. We're not talking about a painting. We're not talking about a piece of land. Of its gross income, which is paid for a charitable purpose pursuant to the terms of the governing instrument. So it's got to be paid from gross income. It's got to be basically pursuant to the terms of the governing instrument. So you can do that, and basically that means that you may get a better break because, again, you're giving ordinary income, and it can be unlimited. So if the trust has $100,000 of income, it can get a deduction subject to one exception for the $100,000. Marty, have I done enough, or should I continue?
No, excellent. Let me give you all a simple example of how you can make this planning work successfully to salvage the entire charitable contribution deduction for even a moderate wealth client. And then as we go on with the slides, we're going to pick up on some of the topics Jonathan introduced and try to more carefully and specifically differentiate the charitable contribution deduction under 170 versus 642C, because there are differences that we have to keep in mind when we do this kind of planning. But let's start on slide 41 with a very simple example of how powerful this can be. So if a client has a $200,000 of investment assets, the client can gift to a non-grantor trust $200,000 of investment assets. And let's say those investment assets earn 5%, that's $10,000 a year. The client can set up a non-grantor trust and name their sister-in-law, brother-in-law as trustee. And each year, that trust could donate the $10,000 of income earned on that portfolio to charity. If the individual had kept the $200,000 of securities, they would have reported that same $10,000 as income. The $10,000 charitable contribution coupled with a $10,000 SALT cap would have been under the $24,000 standard deduction. They would not have gotten a single penny of tax benefit from those contributions, and they would have had to include in income the full $10,000 on the portfolio. By shifting the income-producing assets and the charitable donation to a trust, there's an exact dollar-for-dollar offset, and we've in effect salvaged in the entirety of that $10,000 charitable contribution deduction. The individual on their personal return still gets the entirety of their $24,000 standard deduction. So for a large number of, let's call it moderate wealth clients, a simple local non-grantor trust with these provisions in it will salvage a $10,000 deduction. That will make an awful lot of clients very happy. And I would think in year one, that tax benefit will more than offset the cost of setting up the simple local home state trust. And if you use Uncle Joe or Aunt Jane or your sister-in-law or brother-in-law as a trustee, you're not paying any fees. It's not a complex in terms of administration. It is a complex trust in tax jargon, but it's not a difficult trust that a layperson could not administer. Now, a couple of other points. Why not also include all of the taxpayers' descendants as permissible discretionary beneficiaries in the trust? So if next year the client's child is buying a house and they want some portion of the $10,000 to go to the child, they can, the family member trustee can distribute whatever to that child. Yes, it'll be D&I, so some of the income will flow with it, but they can really have the ability to direct the trustee income, sprinkle income, as between a large class of descendants and named charities. Now,
Mark,
if the law changes, yeah.
let me add one other potential benefit here. If you include the children and you decide for whatever reason that you'd prefer to have the child make the donation, I mean, maybe the child is in a state where they're not only going to get a federal deduction if they make it, but a state deduction. That might be a reason that you want the child to do it. Or the child might say, look, I understand the trust will say this is being made on behalf of Mary Smith or Jack Jones or whatever it is, but I prefer to deliver the check myself. Well, then you can make the distribution to the individual. That will shift distributable net income over to the individual. The trust will still get a deduction. The child will include it in income, but then she or he can turn around and donate it to charity and get a deduction for it. In fact, it might be that the child then could substitute something like a long-term capital gain appreciated share of stock and cash, which might provide a further benefit in doing that way. In any event, having the flexibility to make distributions to the child, whether it's to help them buy a home or just because it's a more efficient way to wind up making the charitable donation or it will look better, it's something that you really should put in, and it can be done. And as Marty has indicated, you don't have to direct the donation to charity to meet the requirement of the donation being made pursuant to the terms of the governing instrument. Discretion alone is sufficient to support it. So if you have a trust which says you can either make distributions to my family, you can accumulate the income and distribute nothing, or you can pay gross income over to charity, you're going to be entitled to that 642C deduction when it's made. In addition, there's another couple of benefits. One is you can retroactively take the deduction. So if I have a trust that has, say, income this year, 2018, but I make the donation of that 2018 to charity next year, 2019, as long as I make that donation essentially by October 15th of next year, the trust can retroactively pretend as though it made the donation in 2018. And one of the things that does is you can see to what extent it would make sense to make the donation from the trust back to 2018. So that's an additional advantage that you can make. So keep that in mind when you do it. And I will add that whenever you're creating a non-trust that's required to distribute its income as a marital deduction trust with, you should almost always put in a provision that gross income can be paid from the trust to charity. Now, it may be that you're going to want the consent of the beneficiaries. It may be that if you give the power to the beneficiaries, you want to make sure that the trustee is okay, because maybe the donation would be to a charity that the family doesn't really approve of. But you could provide an awful lot of flexibility in getting the benefit of donations by putting in an ability from any trust, unless the trust can't be properly formed as like a marital deduction trust, where you can give some of the gross income to charity.
All good points. And I think the flexibility is key, because we have no idea what will happen with the tax laws. Like Jonathan said earlier, there's not only sunset provisions, but if there's a change of administration in Washington, laws could change yet again. On slide 43, just continuing our example, so if we name not just children but grandchildren, all descendants, the first question might be is, well, that's not a particularly efficient use of GST exemption. And that's true. It may not be a very efficient use of GST exemption. And for most of our moderate wealth clients, who cares? Because if a client has got a $10 million estate and the husband and wife together have a $22 million and change GST exemption, if $250,000 or $500,000 is donated to a trust to be used for this purpose, no one's going to really care if that is not an efficient use of GST. But the flexibility it provides, as Jonathan emphasized, is huge, because now you can allocate income, make a distribution, and have D&I carry income out to someone who may get a different benefit. You can meet personal goals. But also, again, if the law changes and the client says, well, gee, I don't need that trust for charitable contributions anymore, well, their entire family, except for spouse, are beneficiaries. The spouse really can't be a beneficiary unless you add an adverse party to approve it, because otherwise you would lose your non-grantor status. Let's go through some of the nuances that are different from the charitable contribution deduction that an individual would get generally under Section 170 versus a trust deduction under 642C. Jonathan has mentioned a number of these, so we'll try not to duplicate them, but let's try to go through some of these because it is important and there are differences. Jonathan mentioned one of the critical items is you have to have the governing instrument has to permit the donations to be made. It has to be pursuant to the terms of the instrument. You can benefit a foreign charity with a trust making a donation. You cannot do so for an individual. As Jonathan pointed out, the AGI limits for an individual don't apply to trust. There's an exception for unrelated business taxable income, which we'll come to. There's a key difference, the third bullet point on 43, and I mentioned it earlier and I want to emphasize it because it's so different than what we're used to. An individual can donate appreciated stock to a charity and get a full dollar for dollar tax deduction based on the value of that stock. For a trust, it has to be gross income that's allocated. So if you just donate a stock that's appreciated to a charity, you're only going to get on the trust a deduction equal to the basis in the stock, whereas if the stock is sold, you will get a full dollar for dollar deduction. That's important because when we do this kind of planning, we have to make sure that the clients and the wealth advisors that have been doing this for so many years realize that it's a trust, not an individual, and the planning is different. Trust contributions, the fourth bullet point on 43, reduce the amount subject to net investment income tax, the NIT tax, which could be useful. There could be a state tax benefit, which Jonathan already pointed out. Let's go to 44. Jonathan already pointed out that you can distribute and deduct gross income from a prior year that had not previously been distributed. The trust agreement on the bottom of 44 can limit. You can set up deductions as long as you have substantial economic effect. There may be some latitude to plan which revenue sources are being allocated to charity. On slide 45, the charitable deductions for trust is not dependent like it is for individuals on the nature or characteristics of the donee charity. So there's a whole range of benefits, and in many cases, other than when there's unrelated business taxable income, the rules applicable to trust can be more favorable than those applicable to individuals. I think the key point that we were trying to get across in these last few slides and some of Jonathan's comments before them is that be very mindful that the rules under 642C have nuances that are quite different than those for the 170 contribution deduction for an individual. So there's great planning opportunities. Just be mindful. Yeah.
Yeah, or here we are. Watch out for unrelated business income. Section 642C, which provides this unlimited deduction, basically doesn't apply to the extent you have what's called unrelated business income, which is essentially unrelated taxable business income, UBTI, which, as you know, a charitable organization has to pay income tax on. Well, what they've done is if a trust has this unrelated business income, such as income from the operation of a trader regularly carried on, and that can be imputed to the organization because you're a partner in a partnership, then you're going to not be entitled to a deduction under Section 642C, but you're thrown back to the limitations under Section 170, which is the bottom point that Marty has there. And I just want to point out that this is something you can need to watch out for. So if you have an estate, for example, which is not subject to the rule, and the estate is going to go to a trust where you can make distributions to charity, but you're going to have, something like an asset that produces this unrelated business income, you better be careful to try to get rid of it. But there's one other option. If in that trust, you not only can make distributions to charity, but you can also make them to individuals, then if you have unrelated business income, you could distribute that unrelated business income to the individual who could make a donation. Now, the individual is going to be limited basically to 30% or 50% or 60% of his or her adjusted gross income. But it may be a lot better doing that than trying to distribute that unrelated business income out to charity from the trust, where you're definitely going to face the 170 limitations, which may be smaller for the trust than for one of the trust's beneficiary. This is a complicated area, and I also want to mention one. Marty, I don't know, do you have a slide here about pursuant to the terms of the governing instrument rule?
No,
Okay,
we didn't.
I mean, this is a subtle point, but an important one. As I mentioned, Section 642C says you get an unlimited deduction subject to the rule for unrelated business income for gross income paid to charity pursuant to the terms of the governing instrument. It's got to be gross income. And one of the questions is that if you've received a lot of cash receipts, how do you prove that you're making the contribution with gross income of the estate or trust? Because maybe the estate has $1 million of income, but it also has 10 million of other assets, or it has 100,000 of income and it has $1 million of cash assets, and you're making a payment to charity. How are you going to prove that you actually paid gross income? And there is a long line of cases which indicate that the IRS can force a tracing rule. It can force you to prove you paid it with gross income. Well, what I've done as a trustee, whenever I'm going to make donations to charity, I have a separate account for gross income. So I put that in a separate account. And then when I make the contribution to charity, I know it's from gross income because I'm paying it from the account. Well, what happens, Marty, if the trust has a deduction, has income that's imputed to it, say, from a partnership? Nowadays, there are many investments made by trusts that are basically pass-through entities. You're a partner in a partnership as a trust, you're a member in an LLC, you're a shareholder in an S corporation, and you're getting the income imputed to you, but you may not get a physical receipt. What are you going to do? Well, what I do, I can't guarantee this would work, but I think it's better than doing nothing, is you sandwich in a new entity between the trust that's going to take the deduction and the payor. So, for example, if the trust is a partner in a partnership, rather than having the trust be a direct partner, you have the trust assign its interest in that partnership to another partnership. And then you have that intermediate partnership that make a cash distribution and tell the trust that this is gross income. Now, that intermediate partnership is going to have a lot of imputed income, and we may not be receiving it, so we can't say we pay it. But it's going to have, say, 100,000 of income, but we will actually pay 100,000 of cash. And the K1 that the trust, which is going to make the charitable contribution, can point to the fact that it's got a K1 from this intermediate partnership and a $100,000 cash receipt, which represents gross income. Now, I realize that that's a lot of work, but if you're going to make significant donations to charity, that you want to get, a deduction for it under Section 642C, and a lot of that income is imputed income. It's not physically received by the trust. I think you need to do something like that in order to salvage your 642C deduction. I realize that's complicated. There's an article by Lad Boyle, Richard Fox and me a couple of years ago in Estate Planning Magazine, which talks about the charitable deduction for estates and trusts. And I would recommend you get a copy of that and listen to what we say about putting in this intermediate entity to try to get the benefit of the 642C deduction for income that's otherwise just imputed but not physically received. So we can't say we can prove that we actually paid it from that gross income.
A related point on the bottom of slide 47 is if it's not clear that the trust has the governing instrument requirement, it doesn't really indicate a positive charitable intent or purpose of the settlor to make donations to charity, you can use a similar approach to what Jonathan just discussed. And instead of the trust making a donation which may not have the support of the governing instrument, if the trust invests in a partnership and the partnership makes the donation, which could be permitted under its governing documents, the K-1 back to the trust will give it a deduction for a charitable contribution, and that should work. Jonathan, on the top of 47, so now that we see that we have these wonderful opportunities to use non-grantor trust for charity, we can certainly structure a trust appropriately and indicate the positive charitable intent in the governing instrument. But what if we have an old trust that we hadn't thought of this? There's a trust set up for a child that's a non-grantor trust years ago, an old trust. Can we enter a non-judicial modification where, let's say, the settlor and the trustee and the child beneficiary under, say, for example, state law agree to a non-judicial modification and add a charitable beneficiary? Would that meet the requirements?
Well, Marty, that's a good thought. The IRS has ruled privately that that does not work. So if you have a trust which doesn't have the positive charitable intent, even if you go to court and you get it changed, the IRS said it won't respect that, and you will not get the 642C deduction because it's not pursuant to the terms of the governing instrument. Here's something that you can consider. I can't give you a guarantee it'll work, but I think it will. Suppose I have a trust and I want to get a deduction for gross income paid to charity, but I can't find the requisite intent in that trust. Well, suppose someone creates another trust, identical to the one I have, but it expressly authorizes the trustee and the beneficiaries to have gross income go to charity. And then I, through a decanting or otherwise, pay the assets from the old trust, which doesn't have the requisite positive charitable intent, over to the new trust, which has the requisite charitable intent. And that, to me, should mean that the income generated in the new trust, which is attributable to the assets in the old trust, if it's paid to charity, it should be deemed pursuant to the terms of the governing instrument. I can't guarantee that would work, but I can't think of any other way in which you could do it.
So just be cautious when you're trying to graft the planning we're talking about onto existing trusts. It's not quite as simple or clear. But certainly going forward for new trusts, this is a great way to circumvent the limitations on charitable contributions. And as we've said, you can build incredible flexibility into these trusts so that should the law change again in the future, then there's lots of workarounds for the client to make distributions to other family members and so on. Also keep in mind, I'm sorry about the slides. On slide, it looks like 48 or 9. If a grantor retains the power to allocate beneficial enjoyment amongst different charitable beneficiaries, that shouldn't characterize the trust as a grantor trust. So there can be some flexibility even given to the grantor, but be very careful, because if you have a trust, don't forget, this has to be a non-grantor or complex trust for this planning to work. If you have a trust where you're giving somebody the right to add charitable beneficiaries, that's something that will characterize the trust as a grantor trust and defeat all the planning that we've talked about. Jonathan mentioned early on when we started our discussion explaining the difference between grantor and non-grantor trust, which I'm sure you're all aware of, but just be very mindful of what powers you do or don't give. And on slide 49 and 50, we outline some of the things you can do and can't do, because if you accidentally taint the trust as grantor, all the benefits you're hoping to get will be lost. Jonathan had mentioned this earlier, and it's something to keep in mind. If you're going to give a beneficiary the right to, or the trustee the right to make a donation, you may want to consent to one of the beneficiaries to avoid the appearance that a trustee is trying to gain favor personally with the charity or benefit one of the beneficiaries' wishes over another. So you may have one or more beneficiaries approve a trustee's donation, and so on. Jonathan, we're getting near the end of the time. Do you want to talk at all about CLATs or CRUTs just for a minute or two before we wrap up?
Yeah, charitable lead trusts, and if you do one, you can have a charitable lead uni trust or a charitable lead annuity trust. I can tell you that mathematically, if you have assets that appreciate in value or produce income, you're going to want to do a charitable lead annuity trust. They're complicated matters, and they're typically used by wealthy people to reduce estate taxation. And basically, the benefit is that you are going to get an income tax deduction for what basically is corpus. So if I create a $10 million charitable lead trust when I die, that's going to be with assets that presumably get a tax-free step-up in basis. I'm giving charity $10 million to get that deduction, and I get no income tax benefit. But if you create a charitable lead annuity trust and you structure it and administer it the right way, basically that $10 million charitable estate tax deduction is going to be paid with income, which makes it much less expensive. Now, a lot depends upon the numbers, and I will tell you one thing, you do not want to have level payments from your charitable lead annuity trust because you may experience very poor investment performance at inception. You're going to want it to have a graduated increase in the annuity payments. That's something you need to do. One of the problems, of course, is that to the extent that your charitable lead trust does not make a donation that year of an annuity to charity, you're not going to get a deduction for it. So the key that you want to try to control is to make sure that the income that the charitable trust receives each year is exactly equal to the amount of the annuity. Well, that's a pretty hard thing to do. One of the ways you can possibly do it is to buy policies of insurance. And then when you want to be paid cash in the policy in exactly the amount that you need to pay the annuity. Now, you want to make sure that it's not going to be debt. So you don't want to borrow from the policy. You want to have a policy so you can terminate part of the policy. The trust will now have gross income, but that gross income can be paid out to charity. That's a complicated matter, but it's worthwhile when you're dealing with a very wealthy client who wants to do a charitable lead trust. The alternative, if during lifetime, is to create a charitable lead annuity trust, which is a grantor trust, because if it is a grantor trust, then the client will be entitled to a deduction equal to the value of what has been contributed to charity. So if I put $10 million into a charitable lead trust and I make it a grantor trust, I will get a $10 million deduction. The bad news is that as a grantor trust, all the income the trust uses, even though it may be paid to charity, is going to be taxed to me. The only way you can effectively avoid that is again through a policy of insurance, because the buildup in a policy of insurance is not subject to income tax. Now, this is a very complicated matter, but there are ways in which you can create a lifetime charitable lead annuity trust that's a grantor trust, be able to get money out of the policies without generating gross income, and therefore you kind of have it all. You have a deduction for it, but you have for creating the charitable lead trust, but you don't have to pick up any taxable income as the trust goes on and pays the annuity to charity. Complicated matter.
Let me just give one last thought and we'll wrap up because we're at the top of the hour. On slide 54 is just a simple illustration how you may incorporate charitable lead trusts into a will or revocable trust for a client to try to minimize or eliminate any estate tax. Don't forget, in 2026, barring any other changes in the law, the exemption is cut in half. So if a client doesn't properly die by 2025, when they have no tax and they live beyond 2025, they may well have a tax. So you might want to use a charitable lead trust structure to zero out the tax after the exemption changes. Just to wrap up, and then I'll turn it back to Jonathan if he has any final comments. There's some new rules on SBITs that are discussed in the outline. The key is that the 2017 Tax Act has emasculated charitable giving. There's lots of creative new ways, especially using non-grantor trust to salvage charitable giving, especially for the moderate wealth client. And the tax benefits in year one can outweigh the cost of setting up the plan. So there's huge planning opportunities. And as we pointed out, there's a lot of nuances to how a non-grantor trust charitable contribution differs from that of an individual. Be careful And we also pointed out at least another half a dozen ways under the new law that you may maximize benefits. We didn't have time for questions and answers, but Jonathan and I will certainly do whatever we can to entertain any questions that you wish to email us. The email addresses are on the board. Thank you for joining. Jonathan, you can wrap up and we'll turn it back to close.
Marty, a magnificent presentation by you. Extraordinarily important things for all of us to consider for our clients. There's a tremendous amount that can be done. Almost everybody has some sort of charitable interest, whether it's a particular disease, a particular cause. And if you plan, you can shift a significant portion of the cost, a portion of your donations over to the government by garnering tax benefits.
Thank you, everybody.